All right, we are officially live. Good morning, afternoon, good evening, wherever you are in the world. Thank you so much for being with us today. Today, we're going to be talking about the state of the single-family investment market, talking a little bit about, Meridian, Memphis, but I think the question on everyone's mind is, what's going on with real estate and what should we expect moving forward? So we intend to address a lot of those, comments, questions, concerns today. And we look forward to spending the next 45 minutes with you guys. So we know you could be anywhere, and thank you for being here with us today. So before we dive in, let me just kind of go around the horn and talk about what we're going to be talking about, who's going to be involved, and all of that good stuff. So corporate and updated national trends. We were going to have our, chief in command, Jeff King, here today, but he is actually out with a stomach bug. So he will not be here. So unfortunately, you get to hear a lot more of my voice, but fortunately, you get to hear more from the rest of our team as well today. So we're going to be kind of pinch hitting and supporting one another to talk about some of this content. So it might be a little bit different structure than per usual. After we go through that, Kent is going to be talking about the overview of the Memphis market, focusing specifically on what we're seeing in the given areas around real estate, rents, evictions, and kind of talking about what the impact has ultimately been on the business center and ultimately your investment properties out there in Memphis. Then it'll be back to me to talk a little bit about what the state of the sales market is looking like. So we're going to talk about interest or mortgage rates, I should say, rents, what's expected, and also what are the upcoming opportunities that we have available. Plus, we have a special incentive announcement that we're looking forward to share with everyone today. And then Wendy Dubé, our client relationship manager, is going to finish this up by managing and overseeing the Q&A, which reminds me, in the Zoom functional chat bar at the bottom there, you should have the ability to type in the chat box if you want to say hellos or comments like that. There's also a questions button that you can press. So as questions come up for you, please feel free to chime in. Wendy's going to kind of use her own discernment to determine, do we want to put that question in right then? Do we want to circle back at the end? Because sometimes you guys have great questions. We're just going to be answering them later in the actual presentation. So Wendy will know that we'll just hold off. But she'll also keep the conversation alive going in that chat box. So please feel free to use that at your leisure. Furthermore, this is recorded. This is going to be sent out. We're going to be time stamping some of the pertinent data points, or talking points, I should say. So if you miss something, if you have to go run off, use the restroom, or whatever it may be, just know that all of this information and data is going to be repackaged and delivered to you in a easy to digest way. So with that being said, let me just turn it over. Kent, Wendy, anything else you guys want to put in before we dive in today?
Nope, fire away.
All right. Well, I'll do my best Jeff King impersonation. Actually, I won't. That'd be a terrible idea. What I want to start with is I want to talk about what's going on in the news. I mean, actually, a number of you have sent me articles. We've had conversations. The media has a lot of doom and gloom going on, some of which the headlines were grabbed, just from the past week that you can see on the screen there. Pending home sales plunged 31%. The housing market is worse than you think. So for a lot of us, this is coloring a very doom and gloom, dark picture around real estate, specifically single family. So what we want to do is we want to address a lot of these things. We want to talk about it because not all areas are created equal, and what we're seeing in Memphis is different than San Diego, is different than Los Angeles. So we want to provide some context as to, a lot of these points are spot on, and they're very specific to very particular demographics or areas. So, it's a good punchline there. The only certainty in life is uncertainty. I mean, a lot of the questions I'm getting are, has inflation peaked? Will the stock market dip below its recent lows? In other words, there is a lot of uncertainty floating out there as to what's going to happen in the economy. The election being this past Tuesday, I mean, even that's going to have an impact. We don't really know what that impact is going to be. We don't know how a lot of these things will shake out. So a lot of people are asking the question, just fundamentally, where will my money be safe? And so one thing we want to comment on is just, about Meridian first and foremost. We know what it is for you guys to trust us with your investments, whether it be to manage it or to purchase from us. We take that responsibility very seriously. And so really the punchline in showing you this slide is we're in a great place. Kent is going to be talking about some of the alterations and changes we're making to the business unit to really accommodate the business cycle. But we've been around since 2006. One of the things I know my father would always talk about was how this business was designed to be nimble, to be able to, provide opportunity. I mean, because with every challenge comes with an opportunity, and in every economic or business cycle, there is opportunity present. And so what we have been circling the wagons around and talking about the past several weeks is, what are we going to do to get out ahead of this issue? And that's primarily the thing we want you guys to understand, is that, we take what's going on very seriously, and we're here to make the appropriate modifications to still provide great investment products for you all. We like this slide. It's comparing the stock market volatility and returns to commercial real estate since the turn of the century. Now, I know commercial real estate is not single family residential real estate. Truth be told, we've been looking for that data and it's really hard to find, mostly because single family residential investments didn't become a real viable investment product, at least according to Wall Street, until about 5 or 10 years ago. So the data is just a little bit more limited. However, the fundamentals are actually very similar to commercial. In fact, one could argue with retail being a little bit more volatile, that single family is some of the most, it has some of the least volatility of the real estate asset classes. The primary takeaway from this here is that you can see that commercial real estate actually outperformed the stock market, which is true to what we know. I mean, more wealth has been created in real estate than any other asset class. I think the number one thing that real estate really has going for it that the stock market does not is this, it's limited volatility. So there can be more of a boom or bust experience with the stock market, as I'm sure we all know, and commercial real estate is really a long-term play. And as long as, they're not building more land and the population continues to grow, that's going to put upward pressure on pricing. So that being said, I want to turn it over to Kent to kind of talk about how the national headlines kind of map onto the Memphis market. So please take it away. Or I'm sorry, this actually isn't your slide. This is my slide. This is just a continuation of what we had been talking about. The national headlines, 7% rates crush builder traffic. I think we all know that the interest rates, or I should say the mortgage rates in particular, have really slowed things down because it's just cost prohibitive to get in real estate today in ways that it wasn't several months ago. And so I think we're all kind of grappling with the new reality and coming to terms with what's so today. Because we'll look at it in a historical context in a minute, but now I'll turn it over to Kent and we'll get back to some of that sales stuff later.
All right. Yeah, so just looking at Memphis and how it relates to the rest of the market. Memphis in general, the big numbers, employment, home values, employment growth, these are all solid and solidly in like the third and fourth quartile in the market. Memphis is not that incredible market that goes to great heights, and then it's not the market that goes to great lows either. And these numbers reflect that, and you'll see that in a bunch of other things we show you. But Memphis' economy is going strong, and as we're going to talk about, there's some things pending that are going to really spike the Memphis economy further coming in the next couple of years. So let's go. But one thing that's kind of interesting, all of these are snapshots, right? These are not movies. Here's a snapshot, but it tells a story of home value decline since the recent peak. So if the recent peak came, somewhere in the second quarter of this year, the markets that went the highest are now falling the highest, and the markets that have been more stable have fallen the least. But what's unique about Memphis is we've had 2 years of double-digit appreciation, much like San Diego. It's been almost identical to San Diego percentage-wise, and yet, we're seeing cities like San Diego and most other cities, we're seeing the values decline at a much faster pace than Memphis. And there's some underlying factors why that is true that we're going to talk about. And this is a slide that we come back to continually that just tells a very important story about Memphis, in that you see on the left the months of housing supply on the market, and the historical national average is 4 to 6 months. You see down at the bottom of that left-hand graph, you see the U.S. National average right now is at about 3.3. That will start moderating towards more traditional rates, of 4 to 6 months. But you can see that Memphis continues to be at the very low end of that, which is really the top end of it. We're only at 1 month supply right now, and that's up from 0.7 months supply 3 months ago. So it has gone up. But what's really important is there is a housing shortage in the Memphis market. without any other forces that we're going to talk about that are coming into the market, right now there's a housing shortage. And yet you've got this dichotomy of it's also one of the affordable markets. And the John Burns, these are all John Burns charts as of September. And as you might guess, we pay very close attention to what we hope is the best research in the market. And we follow John Burns and some others very closely. This is their metric for affordability. You know, what is the typical housing cost for a household versus that household income? And Memphis is still one of the most affordable markets in the country, even with that short supply, which that tells us, yeah, we may have some temporary leveling of prices. We may even see some reductions in prices from the peak. Remember, it's from the peak. It's not from where we started 2 years ago. But long term, we are going to see upward price pressure in the Memphis market. And it's not going to be a rocket ship. It's going to be steady, 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 we think. It could go up faster than that, but we believe it's just going to continue to be this really steady, attractive market. And all eyes, I like that phrase, all eyes are on Big Oval City up in the northeast quadrant of Memphis. We've talked about this before. This is the Ford and SK joint venture investment. Ford is building their F-150 assembly plant, and then they're in a joint venture for a battery plant right next to it. This was 20 years in the making by the state of Tennessee, creating this geography that has preferential treatment, has infrastructure in place. And 2 years ago, Ford finally made a decision. They finally said, hey, that is exactly what we're looking for a variety of reasons we've talked about in the past. Cost of living, access to water, access to services, all access to labor. This is going to create about 30,000 jobs in Memphis. And they are on schedule to start production Q1 2025. They broke ground in March, took all the cement out of the East Coast, I think, and have gone vertical since then. And so they have hit all of their milestones along the way so far. So we have great confidence that they're going to hit their target of being online Q1 of 2025, which means starting in 2024, we're going to start seeing this whole new demand for housing in the Memphis market of people coming in from outside the market. And they will have a different type of buying power than even the current residents. So all the things we love about Memphis, this tells us that it's actually going to get better very soon. And we're actually starting to hear the beginnings of a second plant down in Mississippi, just on the other side of the border. We don't know the details yet, other than the stars are aligning for that to happen in the next 5 years. So these are just great things. And our joint venture, Astoria Development, that is our land development venture, is poised to take advantage of this in great ways. And we want to show you one of those projects real quick. This is the big sexy picture of our Astoria Square project, where we had a groundbreaking. Stay on this for just a second. So this is mixed use in the front. You've got retail, you've got restaurants, you've got some commercial on the ground floor, and then you've got residential on the second and third floor. You've got an apartment complex about a quarter of the way back. And then we're going to have a hotel go up that we will outsource within this property. And then there's a beautiful green belt with a stage. You can see a stage in the middle. There's 250 townhomes in the back there. And this is in Millington. We've talked about Millington. Millington was an old Navy town that is now becoming a booming bedroom community for Memphis. And just as importantly, for Blue Oval up in the northeast quadrant. It's within 30 minutes driving of the big Blue Oval plant. And we had a groundbreaking, if you go to the next slide, just got 2 weeks ago, generated really great excitement. Wendy did a wonderful job managing the PR around this project, got all the great news reports, yada, yada. The city of Memphis, Millington, which is really important. This is one of those rare projects where we are not fighting against the city. The city is saying, come, and they're helping pay for this with some TIF grants that allow us to accelerate the development. This is an incredibly popular project, And, one of the representatives that showed up for this was from Ford. And, they're very eager to start talks providing predictable housing for their staff. And they were very excited about this project too. So this is very exciting. And this is an outcropping of our joint venture development work in Astoria Square.
Yeah. So now, Ken, you can reintroduce yourself for the overview of the Memphis market.
Yeah. And by the way, Jeff King that is his baby. So, one day he will tell you more about it when he's able to do it. But he has been working very diligently on that project for the last 2 years. And you as investors will have an opportunity to invest in those townhomes in about 2 years' time. So we're breaking ground. There's a lot of development work, but that is coming online. All right. And a couple of headlines, going back to Brian's first slide, where do we think we fit in, not just in Memphis, but in the single family rental industry? And the headlines from John Burns for a lot of factors, and I'm just going to hit 2 headlines, is the single family rental industry is poised to ride out the recession risks. And there's a lot of reasons for that, and they're mostly traditional. But if you go to the next slide, the second point is that the SFR industry, that's the single family rental industry, historically benefits from rising mortgage rates as the for sale market cools. And we're certainly seeing some cooling in the retail for sale market, particularly in the higher end homes in Memphis. Fortunately, we don't deal in the higher end homes. We deal kind of in the mid tier. We do have retail homes in the above $400,000 class, and we're slowing construction down on those. And we're going to start getting into a pre-sale mode with those. But this is going to lead to greater demand for rentals as a whole, swath of households can no longer afford to buy. And so they are going to need to rent. And then we'll burn through that cycle, right? And Brian's got some historical data to share that enlightens that further. So let's talk about just some of the basics of property management right now. We showed this slide and another one after it last time we met, and we will continue to show this just to keep you apprised of the rent trends. The blue line here is our rent increase percentages for renewals when we keep a tenant in the property and we renew their lease. But then when the property turns and we have to do a new lease, that's the orange bar. And that's where you see these are by quarters to start from last year. And we started to see tremendous increases in last year in Q2 and Q3 and Q4. And then you see now it's by month looking at this year. And you can see that the new leases have actually started to moderate down. That orange line started off sooner, and now it's moderating down as we get towards the end of this year because the market is adjusting. We've seen these tremendous rent increases, and that obviously that can't go on forever. So the new leases are starting to moderate, but we didn't start increasing our renewal leases aggressively until January of this year. And that's where you see those have steadily increased. I mean, we've never heard of getting renewal increases in the teens before. And now that's been the trend pretty much all of this year, but that can't last forever either, right? I mean, we will reach a point where we will start losing tenants if we continue doing that. But a key inflection point here happened in August, where the rent increases on renewals actually was higher than the rent increases for new leases. That kind of tells us, okay, we're at an inflection point where things are going to start normalizing out after that. And talking about renewal rates, this looks at renewal rates by quarter and gives you a good sense of the seasonality of our renewal rates, meaning what percentage of our tenants choose to stay in that property. And as property owners, all of us are, just like you are, we will obviously want to keep our residents, our tenants in the property as long as possible, particularly the good residents that obviously pay their rent on time, take care of the property. So that's the underlying goal, but we also want to get you the best return. And so when the market adjusts, we increase the rents as much as it will let us. What we have seen in the third quarter here is that for the first time in the last 2 years, the renewal rate actually went down from historical levels in the third quarter. So that tells us, that's part of the story that tells us we're starting to see a normalization in those rent increases. And there's other factors. I mean, there's general inflation in the market. It's people are having to spend more money on everything else, you know, even though they only pay $3 for a gallon of gas out there. But relatively speaking, inflation has really impacted households everywhere, and that includes Memphis. And some of these trends are pretty typical across the market. We're also seeing some slowdown in household formations because people just want to consolidate, right? So we are moderating our rent increases again now, sensing the market, and our leasing department always has their fingers on the pulse. And sometimes you see these really high rent increases on Zillow or Redfin. And what we're seeing over the last 6 months, those are out there from a lot of the institutional owners who are willing to absorb vacancy much more than we are and much more than our owners want to. And they're also cutting deals below that to then actually get, after 90 days, actually get somebody into the property. So a lot of those rents are not reflective of what the real market is. That's where we rely on our experts who have their feet on the ground, seeing what's working. But point being is we want to see that renewal rate always stay above 70%. So we are starting to moderate some things to get back there.
I think, Kent, if I can bring up one more point in your Q3 numbers there, was the fact that we also had a lot of owners take advantage of the appreciation in their properties and decide it was a good time to sell.
Yeah, great point, Wendy. Great point. Yeah, and we actually had one group sell a whole class of properties to a fund. And so that, you're right, that was a big part of that hit. Thank you for pointing that out. So, and this, we're just kind of going back and rehashing some of the same data, just looking at, you know, we show that renewals, rent increases on renewals really started spiking up first quarter, second quarter, third quarter. Fourth quarter, those will start coming back down to normal levels. However, if you haven't gotten a big increase on any of your properties, that means you haven't adjusted to the market yet. So depending on how long you've had a tenant and how long that lease has lasted, you may still see, you know, a double-digit rent increase to get back up to market. It's just, we've been doing this for 18 months now, making these big adjustments. And so the majority of our properties have actually been stepped up. And on the new lease side, the story is much the same. We're just going to see, if you go to the next slide, please. We're just going to start seeing, because the increases have been going on for a full 6 quarters, 7 quarters even, we're going to start seeing these moderate back down. But again, if your property is not seeing, you know, a double-digit rent increase as yet, then there's still room to achieve that going into the next round of leases. And then one thing I just want to hit on real quick, we don't talk about it much, is what are the eviction trends? This is, you know, this is the nasty word for all of us owners. We don't want to, we depend on our property management company to vet residents and get great tenants in there. And we've learned a ton over the last 5 years. And we've been able to lower our eviction rate. And let me take a step back. There's evictions filed and there's eviction putouts. And we track both. And the red line trend there is the actual putouts. That's when people, we use eviction filings to actually generate compliance on paying rent most times. And most of the time that does work out. And we save the tenant and we save the tenancy. But obviously COVID hit in 2020. Eviction moratorium went into place about halfway through the year. But it was lifted in Memphis and northern Mississippi early 2021. And we still had less than a handful of evictions filed in 2021 and literally only one put out in 2021. 2022 is starting to moderate back up to what we think are going to be more typical eviction putouts of about 1% a year. Now, we all can get unlucky. We all can be the owner of a property that can have an eviction. That's going to happen from time to time. But that's where we really believe in portfolioizing our holdings, where once you get up to 5 or 6 properties, if you're not already, then your properties really start mitigating any risks of these one-off events like that. And just a quick update on construction. Brian, if you can go to the next one. Real quick, we're still building in 9 neighborhoods. 4 of them are investor neighborhoods. We are slowing, as I mentioned earlier, we're slowing our pace of construction on some of the higher priced homes. And our overall counts will be about the same in 2023 as 2022. And that applies to investor homes as well. We were originally planning for about a 50% growth in 2023, just because of the strength of the market. But interest rates are going to force us to moderate that a bit, particularly on the retail for sale product. One thing we keep a very good eye on is, okay, what are other builders doing? What are other national builders doing? Because they've got very sophisticated practices. And we also have a very good look at a national builder, that the only national builder that's operating in Memphis, and that's D.R. Horton. We actually sell lots to D.R. Horton through our joint venture. So we've got a pretty good sense of their pace of construction, the nature of what they're constructing. And we're making changes, watching what the nationals are doing. And one of those changes is we are moderating some of our house plans and reducing their size. So, okay, if a buyer can only afford this much now, excuse me, they used to be able to afford this much, now they can only afford that much. We need to lower the size of the house to accommodate their need. So we are creating more of a spectrum of house sizes, so we can accommodate all buyers. And actually, those products then work very well for investors. So we'll have some additional options for you coming down the road. We will have some supply chain issues still. There's a rail strike, waiting to hear what happens with that. But for the most part, our supply chain problems have eased. And lumber prices, the really good news for builders and the market is lumber prices have stabilized to the point where we've got more predictability on pricing, which allows us to moderate some pricing and actually has facilitated us being able to do some year-end incentives, which Brian's going to talk about. You guys have seen this map before. These are all the areas where we're currently building. The gold stars are where we have product available right now. The red stars are where we have a product coming on available next year. You see Ford Blue Oval up there in the upper right corner. That's where the big Ford plant is. And all of those stars up in that area are within 25 minutes, 25 to 35 minutes of getting to that plant. So we've got over 1,000 properties on the books to be built in the next 5 years, both single family, apartment, townhome product, to service that employee base. So we're very excited about that.
Yeah, and just for context, the Astoria Square project is right around where this red star is.
Exactly. And some of that product will be available toward the end of next year into 2024. A little bit unclear. And just an overall perspective, this is builders across the region are quickly pulling back. The only message here is, a lot of this is the higher end homes. The lower end homes aren't pulling back as much. And of course, no surprise, Florida and the Southeast are weathering the storm the best. And particularly Memphis is, I would say, weathering the storm better than most everybody else. You just go up the road 3 hours to Nashville, and it is much more dramatic, the adjustments in the market. That market, has been on fire, and it is coming back down to earth quickly. So there's little pockets that are driving those numbers to where they are, whereas, our housing starts probably will only be down about 20% in our market. So real quick, one of the things we're doing as a company, and we pay attention to what other construction companies are doing, we are cleaning up our balance sheet to be well prepared for this recession. And we talk about what's different about this recession than the big one back in 2008. Well, a lot of things. The one in 2008 was actually created by the mortgage market and the housing market, which drove it. This one is not. But that said, most construction companies have really been working hard to clean up their balance sheets to weather something like this, and we are no different. So we've actually gone out and land banked, which was a new term to us about 2 years ago. Land banking some of our projects where we actually sell the land to a third party but retain the rights to it, and we just pay a fee to retain those rights. So it's off our balance sheet, but we still control it, which is a great way to reduce the risk of your company. And then also we want to clean up our balance sheet on our inventory this year. which is why we're offering some incentives for end of year purchases. So just a quick summary, rents have peaked and they're going to start moderating, but there's still opportunities to get some increases if you haven't had one already. One other point we didn't mention yet is our leasing department is identifying some older properties in need of, some things are just going to, after 20 years, are going to need to be replaced, whether it's roofs, water heaters, whatever. And if you own some 30, 40-year-old homes, things are going to start happening. And we are trying to look at some of those properties and give you recommendations of, hey, it might be time to transition out of that house with a 1031 exchange into something brand new that has more upside potential. And then again, just wanted to hit on the end of year opportunities that Brian's going to talk about. So sorry, there's a lot of information. Want to get to Brian. Back to you.
Yeah, thank you, Ken. I hope you guys like graphs and data sheets because they're coming strong today. What I'm going to be talking about with the sales overview is just talking about the mortgage rates, home values, outlook of future rents, really a lot of the things that us as home buyers care about. We're going to be talking a lot about the buyer incentives as it's going to create a significant shift in the overall return based on the current economic conditions. Being that it is coming up on the end of the year, we just want to remind you all about some of the tax benefits. I mean, tax items that your typical California CPA, for instance, would not know about the Memphis market. Just good opportunities out there. And then certainly talking about the upcoming inventory options. So down here was, I think my face every morning, I would look at mortgage rates for the past like 4, 5, 6 months. I mean, what you're looking at is what mortgage rates have done since the start of 2021. And I think kind of a couple things. First off, non-owner occupied, or think investment mortgages, are typically about 100 basis points higher, plus or minus, than your primary use mortgage would be. So every rate you're seeing here, I mean, basically add another point to it, and that's what you get for a mortgage. So at least as of a few days ago, we were looking at interest rates for 25% down, great credit on an investment property, pushing 8%, which absolutely craters your return. And for context, Ken kind of mentioned this earlier. If you were to have bought a home in January for $400,000 at the current interest rates, then if you put that same amount down as a percentage today, you can afford about $274K of house. So that's about a 32% drop in what people can afford today versus what they could just about 9 months ago. So that really is rocking the market, and people are having to respond in kind, whether it's building smaller homes, but this is a real thing that is, pricing people out of certain properties. I've heard a lot of different estimates. I know the last webinar we talked a lot about historical trends, what happens in an inflationary market or a recession as far as interest rates. And a lot of the data was suggesting that rates are going to go down. Well, John Burns, once again, that the leading consultant in our space is echoing the same sentiment. What they're saying is that, you can see this yellow bar rates at this snapshot in time, which was just a few weeks ago, we're at about 6.7%. I think we're about 7 now. And they were expecting rates to hover somewhere between 5 and 6% for the next several years. So the days of interest rates that start with a 3 for investor properties, at least for the foreseeable future, according to this expert, are not necessarily right around the corner. So that's something, we're obviously monitoring because that's going to have a great impact on the overall return for investors. This slide again, because I think this slide is very telling. The main point again here is just all metropolitan areas are created differently. And so if you see Wall Street Journal or New York Times talking about how there's a big crash in the market, well, look at a couple things. Which market are you talking about? Because the West Coast and Southwest markets, Phoenix, most of all of California, even in the Pacific Northwest, have all really been hit the hardest. Places like Memphis, specifically in the Southeast and East Coast, have not been hit quite as strongly. Other thing to mention too is the closer you are to the median home price, the less volatility your home value is going to have. So that's one of the reasons why we don't do the $400,000 investment properties. We're doing the ones that are much closer to the median home price. So overall, that's providing a much more stable price or home value for your property. All right, so now the nation is still underbuilt. That I feel like for the past 2 or 3 years, we've been talking about how this is a reality. And what this graph shows, you can see the dotted line, that represents what the historical average should be to accommodate the need that our country has for housing. And so while there's a precipitous drop off that everyone has talked about, and you can see the percentages here, they're still significantly more than they had been in the past decade. So we're actually tapering off to what would be normal conditional amounts of homes to be built annually. So I just show that for context, because when most people say, you know, these doom and gloom notions of building's going to come to a screeching halt, you know, much of us believe that just simply isn't the case. However, the type of product that gets built, the size of product may absolutely need to change just based on how affordable these homes are. Now I want to look at rents, because naturally, once we own a home, lock in that sales price, we really care about the rent when it comes to how the overall home is going to perform. And what I like about this chart is it shows some historical data really in the past 20 years of how rents have performed in Memphis specifically. So this is Memphis, October 2022. So you can see 4 times over the past 20 years, the rents have dropped by maybe not even 2%. It's closer to about 1. The other thing that's worth noting is in 07, 08, when the crash occurred last time, that's actually when rents went up the most. And my belief is that a lot of home buyers were no longer homeowners. And so they now had to move into the rental market. That supply and demand issue shows up, and that ultimately starts to bid up the rents. With mortgage rates being as high as they are, fewer people are going to be able to afford, more people are going to move into the rental market. So that does bode well for what rents will do, as you can see from this chart, that we're still expecting at or above historical average numbers for rent appreciation. You can see right here that, you know, rents had, you know, gone up quite a bit for the remainder of this quarter. I mean, honestly, it's the usual fourth quarter slowdown that we have seen pre-COVID is finally back. The past 2 Decembers, we actually had incredibly strong leasing seasons, which had never happened before COVID. So now we're kind of back to that October, November, December slowdown, which is, you know, meaning that we're not collecting as strong of rents as we are and expect to get once January rolls back around. All right, so now let's talk about what we are doing to incentivize investors as we're looking to clean up our balance sheet. Once again, you guys are very lucky. You get to see a picture of me when I've found these additional investment products and these incentives that do a great job in enhancing the return. So ultimately, there's up to 25K in total incentives. It's about 10 to 15K off the sales price, depending on which model home you're looking at. We're crediting up to 5K in closing costs, which can allow you to buy down rates or just wipe out your closing costs entirely. We're providing a 5K in your ongoing management. So that can go toward your lease up fee. So in essence, your lease up fee is waived. And then there's additional 3,000 thereabouts to go towards your management fee. If there's a rent shortfall because we leased the home at a slow time of year and didn't get quite the rent we were expecting, it would go to supplementing that. So the idea here is that we're getting up to, you know, 20, 25K in additional incentives for buyers for any home that you close on between now and the end of the calendar year of 2022. Second thing that is hugely important is ever since these mortgage rates started to get above 6, we were in an all-out mode as far as how do we find better loan products. We know they exist for highly qualified borrowers. So we were looking for the private equity banks that would be able to provide non-QM or non-qualified mortgages, basically non-conventional loans that are not, you know, Fannie and Freddie backed, because they have more freedom and flexibility into the type of loans that they offer and to who they loan them to. They're not constrained by those FHA requirements. So the best one that I have found recently is truly terrific. Rates are starting at 5 3/8, and it's a 5/1 ARM, meaning your rate is locked for 5 years, and then every year thereafter it resets. Other good thing about this particular loan product is there's no prepayment penalty. So if rates get back to a palatable level in the next 5 years, at least my strategy is to then do a refi on a property, perhaps even a cash out refi, harvest some of the equity, reset my loan into a 30-year fixed loan product. So the net effect of these two things here are pretty drastic. So what you're looking at here is one of our typical pro forma spreadsheets where I've kind of listed out the no incentives conventional loan model, and I've listed that next to the incentive plus this alternative non-QM loan product. So you can see the 10K discount on the sales price, which is 15K below the market value. One of the great things is you have to come to the table with about 11, 12% less money down. So instead of 91.2, you're coming in with 81.6, which obviously is fantastic. LTVs are the same. You're putting 25% down. Your interest rate is 7.75% versus 5.375%. And look what it does to the cap rate. So I was sharing with you that we expect cap rates to kind of get back to these more normal ratios, which I would say are kind of in the mid fives. And what we've looked to do is actually to get to mid fives now, because that's where we kind of expect the market to stabilize. So this allows us to sell the types of homes that we want to sell now, clean up our balance sheet, make sure we're holding and building the right amount of product, which is why we want to extend the savings over to you. So that's almost, I mean, that's a 90 basis point difference in your first year cap rate, which is very significant. And you can see that makes a huge difference. That's about a $7,500 flip in cash flow in year one when you include in some of these additional credits. Once again, this has now made it back into the world of positive cash flowing. I do have, relatively conservative underwriting here in the sense that I have factored in vacancy and maintenance in times when we probably won't have it. But the point is, we are now back from a negative 6% cash on cash return to something that starts with a positive number, which is fantastic. The other really jarring statistic is you're coming to the table with less money down and you're getting a more than double return. So this IRR shift of 6.4 to 12.2% is pretty drastic as far as what it's going to do to your overall return here. All right, so that's the incentive piece. Now I want to talk about, as just a nice little reminder, about some of the year-end tax strategies and benefits. I would highly recommend you bring these up and talk through them with your CPA just to make sure that they are taking them into account. So first off, depreciation. So quick recap on depreciation for an investment property. It's a depreciating asset. What they do is they take the structure value of a property, divide that by 27.5 for whatever reason, and you can depreciate that amount on your tax return each year. Well, California, CPAs will normally do 50% of your value is in structure and 50% is in land, meaning you can only depreciate the land value, the structure value, which is 50%. Conversely, if you were in Memphis, about 80 to 85% of the value is the structure, meaning if you own $1 million worth of real estate in California, you can only depreciate 500K of it. In Memphis, if you had $1 million worth of real estate, you can depreciate 850K of it. So that is a huge tax shelter and savings. That is terrific. And to be honest, my CPA had no idea about this. And a few years ago, I had to educate him and show him tax statements to give him this breakdown, as it's a pretty significant shift. The second thing a lot of people are doing is around cost segregation studies, which historically that has been a commercial thing, meaning, let's say you have an apartment building. There's a lot of things that are depreciable, the roof, the faucets, things like that. And a cost segregation study was, well, instead of doing depreciation over 27.5 years, what if I accelerate part of it and I take a larger chunk of it now, and then I straight line depreciate the rest? Well, about 3 years ago, you could start doing that for single family homes. And the main benefit is summed up in the next bullet point. You can depreciate about 29% of your structure value in year one. This is especially important for real estate professionals because they have no limit to how much they can depreciate. A non-real estate professional may be limited to 25K, but you can roll over whatever you don't use into future years. So this is an opportunity to shelter more income that a lot of people are taking up. In fact, there's one investor that, or actually I should say a few, that come to the table to buy one home each year just so they can do the cost seg and shelter more of their ultimate income. As far as how that shakes out in their overall return, it's a pretty significant savings. The last thing I want to share is that we want to offer a referral program. So for the time being, we have no end date in mind. This will certainly be going through the end of the year, but chances are it'll probably continue beyond. But it's a referral program. Anyone that you refer us to, if they buy a home, and for every home they buy, you will get a $500 credit to your property management account. Now, what that ultimately means is that $500 per property. So if they buy 10 properties, that's $5,000. That'll get credited there. And if you don't use that money because of maintenance or return, you will get that money ACH to you in that next owner draw. So it can basically be as good as cash. It's just going to be applied to your property management account first. All right. So to kind of glean over what those main bullet points are that we just talked about, we have these new incentive returns, or these incentives that ultimately enhance returns. These are tangible assets that offer an immediate, predictable income stream. And being that it is a conservative hedge against inflation, We are still in an inflationary market, even though I think as of this morning, it seemed to be down into the sevens as opposed to nines. It very much is an alternative to the stock market. One thing, we always talk about how it's turnkey, and it's also a set it and forget it type strategy. And the thing that I think is especially nice about that is we really have it that it's our fiduciary responsibility to keep people apprised, kind of to Kent's point earlier about if neighborhoods start to turn for the worse, or if a home starts to just get a little long in the tooth and a little bit of a maintenance nightmare, we will come to you and suggest that you consider selling it, doing a 1031 exchange into something new. It's also a great way to harvest a lot of the equity that people have gained through appreciation. So something that we are, always here to help with. And certainly our strict underwriting policies are helping to get better quality residents in place. And I mean, compared to the industry norm, we have far lower eviction rates than do our competitors. The punchline is the Memphis rental market is strong with room to appreciate based on the affordability we discussed earlier. And the local economy is strong, and there's a lot of plans in the works to continue that growth. So for a lot of those economic reasons, it gives us confidence in the fact that it's going to be an attractive place for people to live, as there's going to be readily available work, which is ultimately going to create a need for housing and is going to put upward pressure on both home prices and rents alike. So that kind of covers the 10,000-foot view as to what's going on and what we're offering. I'm going to run through these last 4 projects as far as available inventory. We covered these exact same 4 communities last time. So there's going to be a lot of whole new information here. So the 4 communities are Mallard Park down here, Nicole Place and Horn Lake, and then Cedar Bluff and Olive Branch. So Cedar Bluff, Olive Branch, one of the best school systems in the county, although all 3 of these are in a great school system area. And the Hedgerows community, which is going to be in the second quarter of next year, is going to be a great place to own for anyone that wants to have housing readily available for the Ford Blue Oval plant. So we're pretty excited to be back in that market and building in earnest here. I think we just broke ground on that community, or I'm sorry, the development's about to finish up. We're going to be breaking ground probably in January. So once again, Walls, what we like about it, really good school system. It's kind of an up and coming community. So you're getting a little bit better price per square foot on it, and kind of getting in on more of the ground level. So we have about, I think, honestly, about 7 homes left that we're looking to sell this year. 4 to 5 bedrooms. This is an area of the plat map. We started on this part, building, and I would say we're right about here right now when it comes to the available inventory. So we have, the last 45, 50 homes to sell over the next, I would say about 1.5 years. Next up is Nicole Place. This is a place we've been building in for almost, 7, 8 years. Once again, another great school system. There are a lot of logistics related jobs and warehouses coming into this area. It's just south of the Memphis airport. And a lot of these suburbs in Horn Lake and South Haven are kind of the home mecca for those, a lot of those logistics related jobs that have come into the Memphis community. Once again, a little pick of the plat map. We built out, I don't know, 30% of this left part of the community, and now we're building out about 30% of this right part of the community with the mixture of for sale and rental properties. All right, Cedar Bluff. Honestly, we're probably going to have inventory available in late Q4, so late December. So that would be a possibility for the discount. I feel like Olive Branch is, that was one of the areas that I think we most were heavily focused on when we first broke into Memphis, as it's just got an amazing track record. It's consistently ranked one of the top cities in the United States to call home. So that place really speaks for itself. And there's going to be a combination of townhomes and single family homes available in Cedar Bluff. And the last one is Hedgerows, which I talked about earlier. This is one that's in a town called Somerville, which 2 great things going for that place. That place used to be semi-rural. It's going to be losing that stigma based on the fact that there's a lot of jobs coming to that local market. And secondly, it has one of the lowest property tax bases, I think that's right, in the entire Memphis metropolitan area, meaning those are going to be our highest cash flowing assets that people are going to be able to get their hands on as soon as, I would say, April of next year. So that is a wrap for the content we wanted to get to. So Wendy, I turn it over to you. Do we have any questions going on in the chat
Yeah,
box?
I don't have any questions. I'm going to encourage people to either put it in the Q&A if you have any questions, or, I don't know if anybody can raise their hand, use that feature at the bottom of the screen. And maybe we can call on them there, just in case the chat isn't working.
Unless we are just so great at getting out ahead of questions, which is a distinct possibility. We'll give about another 30 seconds here to post any questions you may have. And just while we're waiting, I just want to re-echo and re-emphasize and say thank you to everyone. It's really been an honor to have you all as part of the journey. I mean, it's been kind of cool. I know my father really started off having the majority of the relationships, as he was kind of the representative of the California office where many of our clients are. And it's been a real honor to work with him, to work alongside him, and then kind of to feel the baton getting passed to me, where I've really gotten to develop, tremendous relationships with a lot of you. And so I just want to say thank you from the bottom of my heart. Thank you for staying, being part of the Meridian community and continuing to trust us and, managing your assets and being kind of a guide for navigating this part of your investment portfolio. So doesn't look like we got any more questions at that time. Kent, Wendy, any final remarks before we close down here?
No, just want to say thank you to everyone for whether you're watching live or recorded. Thank you for your trust in us as one of your investment partners. And just know that we're doing our best to build your investment. And in most cases, we are all right beside you in that world. And we're very bullish on real estate long term, as we know you are, because you're in the market. And we just thank you for your trust.
All right.
Yeah,
Awesome, guys. Thank you again. We'll catch you next time. Have a great holiday season, y'all.
Thanks.